Welcome to the Deep Dive, where we crack open the latest earnings calls to extract the most crucial nuggets of knowledge for you. Today, we're taking a deep dive into Sunrun's second quarter earnings. This was a call that, well, it genuinely captivated the market, offers some really fascinating insights into where the company is headed.
Indeed. And, the market's reaction to these results was pretty significant, very positive, which isn't just a fleeting blip, I don't think. It strongly suggests a real fundamental shift in investor sentiment,
Right.
signaling that the company's strategic direction is finally maybe resonating. We're looking at a narrative that's truly evolving here.
Okay, let's cut right to it then. Let's unpack those headline numbers, because Sunrun delivered a quarter that, well, really turned heads, significantly exceeding expectations pretty much across the board.
They absolutely did. Starting with the bottom line, Sunrun reported GAAP diluted EPS of $1.07.
Wow.
Now, for context, that's a substantial beat against a consensus estimate that was actually negative 0.09 cents.
Right, negative 9 cents. That's quite the turnaround.
Exactly. It's not just beating, that's a complete flip. Revenue also came in strong at $569.3 million, easily surpassing consensus estimates and marking, a healthy 9% year-over-year increase.
And beyond those impressive top and bottom line figures, one metric that really jumped off the page for me was their contracted net value creation.
Yeah.
They hit a record $376 million. That's an astonishing 316% year-over-year growth. What does that number actually tell us?
Yeah, that's an excellent question, because this isn't just a big number. For a subscription-based model like Sunrun's, contracted net value creation is a direct forward-looking proxy. It really speaks to future revenue predictability and the long-term value embedded in their customer contracts.
Clear.
So this kind of growth validates their strategic shift, away from purely one-off sales. It tells us they're not just installing solar panels, they're building a highly valuable recurring asset base, predictable cash flows for years to come. It's fundamentally about the health and the growth of their recurring revenue streams.
Yeah. Right, building that long-term value. And kind of hand in hand with that, we saw a record storage attach rate for new customer additions.
Yes, a record 70% storage attach rate. Sure. And installed storage capacity grew 48% year over year to 392 megawatt hours. This 70% attachment rate, it isn't just operational efficiency, it's the bedrock of their pivot. Their pivot to this new identity as a distributed power plant operator.
That's the key phrase they keep using.
Exactly. It unlocks entirely new, potentially high-margin revenue streams from grid services that, pure installers simply can't access. This, in my view, is a fundamental re-rating driver for the company, suggests maybe a much higher valuation multiple down the line.
Makes sense.
And it also marks their fifth consecutive quarter of positive cash generation. They brought in $27 million, which keeps them solidly on track for their full-year outlook.
Okay, that's a powerful set of results. Let's really dig into the strategic implications here then. Beyond the raw numbers, these Q2 results really underscore a significant strategic shift for Sunrun. What's truly fascinating is how management is actively reframing the company's entire identity.
Absolutely. This is the core narrative, isn't it? They are explicitly transitioning, moving from primarily a rooftop solar installer to what they describe as the nation's largest home-to-grid distributed power plant operator.
Right.
This pivot, as we just highlighted, is heavily reliant on storage. That record 70% attachment rate for new customers isn't accidental. It's definitely by design.
Right, it has to be.
This intense strategic focus, combined with impressive cost discipline, was a key driver for their record value creation. Think of it as aggregating thousands of individual home batteries and solar systems into one massive, controllable virtual power plant that can sell electricity and, crucial grid services back to the utility, generating new revenue streams and significantly enhancing grid stability.
So that emphasis on storage isn't just about adding batteries to homes. It's fundamentally transforming their entire asset base, isn't it? It changes the whole game.
Indeed, it's a game changer. Sunrun now commands a fleet of home batteries representing over 3 gigawatt hours of dispatchable energy. That's energy they can call upon when needed alongside nearly 8 gigawatts of solar generation capacity.
That's a lot of capacity.
It is. And what's more, over 71,000 customers are actively enrolled in their home-to-grid programs. That's a staggering 300% year-over-year growth.
300%.
Yeah. The company estimates an incremental net present value of $2,000 or more per participating customer from these programs, an estimate they now believe is likely conservative.
Conservative, wow.
And they've laid out an ambitious but clear vision, having more than 10 gigawatt hours of dispatchable energy online by 2029. That's a massive leap in capability and, well, value creation.
Okay, so with this strategic pivot towards being a distributed power plant, what does it all mean for their financial health and their overall capital strategy? I mean, how are they funding this transformation?
Well, this strategic pivot, driven by storage and grid services, has profound implications not just for operations, but critically for their financial health. Sunrun achieved the highest upfront net subscriber value quarter in its history. That reflects a remarkable 17 percentage point margin improvement year over year to an 11% margin on contracted subscriber value.
17 points is huge.
It really is. And this wasn't magic. It was driven by two key factors: increasing the contracted subscriber value they secure from each customer while simultaneously reducing their installation and customer acquisition costs.
Doing both at once.
Exactly. It's a dual-pronged approach to efficiency and value capture.
And beyond just generating value, it sounds like they're also making concerted efforts to shore up their balance sheet, managing their debt.
That's right. They paid down an additional $21 million in recourse debt in Q2. For listeners less familiar, recourse debt is essentially debt where the borrower, well, the company, remains personally liable. Reducing it signals a stronger financial position, lower risk profile.
Good signal to send.
Definitely.
Yeah.
This brings their total recourse debt reduction to $235 million since March of last year, while they've simultaneously increased their unrestricted cash to a healthy $618 million. They anticipate paying down $100 million or more in recourse debt for the full year 2025, which sends a very clear message about their commitment to financial discipline and deleveraging.
That's a strong move.
Yeah.
How does this financial strength translate into their ability to access capital markets for further growth? Tell us about their capital market activities.
Yeah, their access to capital markets seems to remain robust. Sunrun successfully priced its third securitization transaction of 2025 back in July. They refinanced $431 million in residential solar systems at a yield of 6.37%. These asset-backed securitizations, or ABS, they're a critical funding mechanism, right? They bundle customer contracts, use them as collateral to raise capital. This brings their year-to-date ABS total to approximately $1.4 billion. Demonstrates healthy investor appetite for their underlying assets.
Seems solid.
And on top of that, they secured $1.7 billion in tax equity in 2025. That provides a strong, long funding runway to support their continued expansion.
Okay, let's shift gears a bit. Policy. Always a huge swing factor in the solar sector, right? Creates tailwinds, sometimes headwinds. How are they navigating that complex landscape, especially with an eye on those distributed power plant aspirations?
Policy is indeed paramount, yeah. And management is proactively engaged, they say, in Washington, D.C., trying to highlight the unique value of their distributed power plant model. A crucial point they emphasized is that 94% of their new customer additions are subscription-based.
94%. Okay.
This structure is key because it primarily benefits from the Commercial Investment Tax Credit, the ITC, under Section 48E. This is distinct from the Homeowner 25D credit, which is for people who purchase solar outright. That one's set to sunset at the end of 2025.
Okay, so they're mostly using the commercial one.
Primarily. And that difference in tax credit exposure is a significant differentiator for them compared to some others.
That's a critical distinction.
Yeah.
But what about the 48E itself? That one also has a step down on the horizon, doesn't it? How are they planning for that?
You're right. Yeah, the solar portion of the 48E credit is indeed set to end in 2028, though it does remain for storage through 2033.
Okay, storage gets longer.
Right. So to mitigate this anticipated step down for solar, Sunrun has implemented a clever and proactive strategy. They've commenced construction on projects to safe harbor solar credits, potentially through 2030.
Safe harbor, how does that work?
It leverages Treasury guidance. It basically allows qualification for the full credit if physical work or 5% of project spend occurs by July 2026. This effectively extends their eligibility for these critical tax benefits well beyond their scheduled expiration. It de-risks a major policy exposure.
Got it. So they're buying themselves time.
Essentially, yes. And they've also expressed confidence that any new Treasury guidance would be prospective, not retroactive, which further reinforces their strategy.
That's a smart tactical move.
Ugh.
So even with those credits eventually stepping down, what's their plan for offsetting that reduction? How do they maintain profitability?
Their confidence seems rooted in a multifaceted approach. They believe they can more than offset the reduction through a combination of things. Pricing increases, which are often benchmarked against, utility rate escalation, ongoing equipment cost declines, further reductions in customer acquisition costs.
Makes sense.
And crucially, increased grid services value as their distributed power plant model scales up. All of this, coupled with ongoing operational efficiencies across the business, that forms their strategy to maintain and even grow value.
Okay, moving beyond the past quarter, what are they projecting for the rest of 2025? Let's talk guidance.
Right, guidance. For the full year 2025, their aggregate subscriber value guidance remains unchanged, still at a robust $5.7 billion to $6.0 billion. However, and this is where the real confidence shines through their contracted net value creation guidance, was significantly raised.
Raised by how much?
To a range of $1.0 billion to $1.3 billion. That's up sharply from their prior range of $650 million to $850 million.
Oh, wow. Okay. That's a big jump.
It is. This raised guidance directly reflects the success of their strategic pivot and that cost discipline we talked about. Full-year cash generation guidance remains reiterated at $200 million to $500 million.
Okay, so cash is steady.
Steady outlook there. And for Q3 specifically, they expect aggregate subscriber value of $1.5 billion to $1.6 billion, contracted net value creation of $275 million to $375 million, and cash generation between $50 million and $100 million. All in all, a very confident outlook, I'd say.
Here's where it gets really interesting, I think, because this quarter truly reframes Sunrun's narrative. It shifts it from one of just survival in what's been a challenging market to scaling a distributed utility with significant future potential.
That's a critical observation, and I couldn't agree more. Their record storage attachment rate, the impressive profitability, they're undeniable signals of a successful strategic pivot. The market's strong positive reaction, even despite maybe an initial dip right after earnings, indicates that investors quickly process the implications.
They got the message.
Yeah, they got the message about that raised guidance and the profound underlying business transformation. It's a clear re-rating event happening or starting to happen.
And their proactive approach to policy risk with that safe harboring strategy that also seems to be a key differentiator really sets them apart.
Exactly. By commencing construction to extend solar ITC benefits potentially through 2030, Sunrun is proactively de-risking a significant policy exposure. This particularly distinguishes them from companies more reliant on that expiring 25D homeowner tax credit.
Right, the ones focused on outright purchase models.
Precisely. This strategic foresight, coupled with their increasing scale in grid services and the launch of initiatives like the Tesla Electric plus Sunrun Flex plan in Texas, it clearly strengthens their competitive moat and demonstrates tangible progress in monetizing their distributed energy resources beyond just the initial installation.
And it sounds like the analyst community has definitely taken notice of this shift as well.
They absolutely have. The analyst community has largely turned more constructive. You see firms like Susquehanna, JP Morgan, RBC upgrading their ratings, raising price targets post-earnings.
The upgrades are coming in.
Yeah. This reinforces the idea that Sunrun is successfully evolving, moving from a pure-play installer to a scaled distributed power plant operator. They are leveraging their deep storage penetration, expanding grid services, and demonstrated financing muscle to kind of compound value for years to come. It's a very different company, really, than it was even a year ago.
All right, now for something a little different, let's consider this our investment committee session where we brainstorm some potentially audacious yet, highly plausible trade ideas for Sunrun. The market just absorbed a quarter that fundamentally shifted the narrative from survival to growth, and yeah, the stock popped. But I still think there's a significant, perhaps largely unappreciated opportunity here.
Okay, interesting. My first idea leans into that long-term transformation we've been discussing. Consider maybe a long-dated, out-of-the-money call option strategy, targeting, say, 2027 or 2028 expiration with a strike price around $30, $40.
Okay, long-dated calls. What's the thesis?
The core thesis here is that the market is just now starting to price in Sunrun's true transition from just a rooftop installer to a scaled distributed power plant operator. Management's guidance for more than 10 gigawatt hours of dispatchable energy online by 2029, combined with that likely conservative estimate of $2,000 or more in incremental NPV per grid customer.
Right, the grid services value.
Exactly. It implies a massive, largely unappreciated revenue and cash flow stream from grid services that's still in its, nascent stages. If they successfully scale this and state-level programs for dispatchable resources accelerate, maybe due to energy capacity challenges, especially with AI driving power demand,
Good point. The AI demand.
the market will or could re-rate this company from a solar installer multiple to something more like a virtual utility or energy tech multiple. The stock, even after its recent surge, is still significantly below its prior highs, and the structural tailwinds, energy independence, grid resilience, growing storage footprint, they're powerful. This call option offers asymmetric upside exposure to that multi-year re-rating without tying up excessive capital in the underlying equity immediately.
Interesting. Asymmetric upside. Okay, for a second idea, and this is where that policy discussion earlier becomes critical. How about a pairs trade, long Sunrun, short a basket of pure play, loan-financed residential solar installers, heavily exposed to the 25D tax credit?
Playing the policy divergence.
Exactly. The earnings call made it crystal clear. 94% of new customer additions are subscription-based, primarily benefiting from the 48E commercial ITC for Sunrun. Meanwhile, the 25D credit, the one for homeowners who purchase solar outright, that sunsets at the end of 2025.
Right, that cliff is coming.
And Sunrun has proactively commenced construction to safe harbor projects, potentially retaining full solar ITC benefits through 2030. Competitors relying heavily on 25D could face, according to management, a 25% contraction in the overall market by 2026, with much of that volume simply going away. Sunrun is structurally positioned to benefit from this market shakeout, potentially gaining market share while maintaining margin discipline. This trade capitalizes on Sunrun's superior positioning and, frankly, strategic foresight in navigating policy changes, while simultaneously betting against the structural headwinds facing less diversified or less strategically advanced players in the residential solar space. The divergence in policy exposure and business model resilience seems like a clear alpha opportunity here.
That's a compelling rationale for a pairs trade, leveraging that policy difference.
Okay, so to quickly recap this deep dive then, Sunrun delivered an outstanding second quarter, driven by record contracted net value creation, exceptionally high storage attachment rates for new customers, and a solid 5 consecutive quarters of positive cash generation.
Yeah, and the key takeaway is the company is not just installing solar anymore. They are strategically transforming into a leading distributed power plant operator. They're leveraging their rapidly growing fleet of home batteries for grid services, which is expected to generate significant recurring future value. And crucially, they've also proactively managed major policy risks by safe harboring those tax credits potentially through 2030.
Right. And while cash generation in Q2 saw some impact from working capital, the full-year outlook remains strong, reiterated with conviction. The market's overwhelmingly positive reaction really underscores a renewed confidence in Sunrun's strategic direction and their financial execution.
Absolutely. And as always, remember that this discussion is purely for informational purposes. It should definitely not be considered financial advice. Please conduct your own thorough due diligence before making any investment decisions.
It's clear that Sunrun is charting a new course, moving well beyond a traditional solar installer model. Leaves us wondering, doesn't it? As the energy landscape continues to evolve, could this aggregated, distributed power plant model become the blueprint for how utilities of the future operate? We appreciate you tuning into Talk Tickers, and we look forward to your insights and feedback on this transformation.